Our first speaker is Tony Lettich, and Tony is the managing director of the Angel Roundtable, which is a select network of successful business leaders, entrepreneurs, and investors in the community, in the region, and he'll talk more about that and what he does. His background, he has a background in corporate venture capital, mergers, acquisitions, lots in the financial world. He served as a VP and CFO of a major corporation in Atlanta with sales totaling nearly $1 billion. So he's got great experience, he's a great guy. He was originally from Beaufort, South Carolina, and he attended college in South Carolina. I joked with him earlier that he attended the only college in the SEC that Tennessee was able to beat this year, the University of South Carolina. The Gamecocks, or the Game Knots. What was it used to be called?
Shamecocks.
Oh, the Shamecocks before they were good. Yeah, before Spurrier came in.
Pre-Spurrier, yes.
Yeah, pre-Spurrier. Yeah.
Down there, it's we use the BS as well. It's before Spurrier.
Oh, right. Well, Tony's married. He's got 2 boys in high school. He's a great guy. He's going to be our first speaker. So welcome him, Tony Lettich.
Thanks, Josh. Well, good morning. We're going to talk a little bit this morning about angel investing. And as you know, there are a number of ways to finance your company. Bank loans, personal investment, friends and family, all the way down to IPOing it in the public markets, bond offerings, etc. So there's just a variety of methods. Of course, didn't include loan sharking in here, but I guess that's a methodology as well. But we're going to focus on angel investing and VC investing for seed, late seed, and early stage opportunities that you may have. In that light, let's talk a little bit about what is an angel investor. An angel investor is someone who provides capital for startup to a business. Generally, again, it's a seed or a very, very early stage company. A few guys who've gotten together, they have an idea. They think they can take this idea and make something big out of it. And they usually do that locally, one-on-one. But over the last 20 years or so, with the proliferation of the internet in about 1990, angel networks began to form and primarily started out on the West Coast. But these networks are groups of people who get together for the purpose of facilitating potential investments in companies. And so we're gonna talk about that in a little more detail this morning. But before we do, what I'd like to do is to welcome you, because through your attendance this morning, you have all become angel investors. And you've become members of TRAIN. TRAIN is the Tri-Cities Regional Angel Investment Network. So welcome to the organization. I am managing director of TRAIN, and my goal and objective this morning is to share with you a little bit about angel investing and why it's important, how it works, and how it all fits together. And what my objective is that you put your minds on the investment side of the house. You are now going to be making investments in companies. So I want you to think about it from that perspective. What are the risks and what are the benefits of becoming an angel investor? Some of the companies that have been backed by angel networks and angel investors include these that you see here on the board. And this is just a very, very short list. But I think at least 1 or 2 of those are familiar to each of you. Angel investors, as you can see here, which you're now a part of, invest in seed stage. Seed stage is really an idea, a concept where 2 or 3 people again get together. They have an idea, they produce a prototype for that idea, they begin to form a management team, they begin to pull together advisors, partners who will help them take it forward. They begin to pull together a strategic plan and then move forward in finding investors to support the growth and development of the concept. As you can see from this chart, angel investors invest strongly in the seed and early stage, and some in the investment stage, in the expansion stage. Your VCs or venture capitals, that's institutionalized investment. You guys, I'm sure, are familiar with that, at least at some level. These guys follow generally the angel investors. Some of them will do some smaller projects, some seed and some early stage, but you can see from this chart on the orange bar, they really begin to kick it in as the expansion stage tends to become a reality. How much do angel investing groups invest in any particular entrepreneurial company? We in Train would expect to invest somewhere between $100,000 and $1 million in any particular deal. And the way we do that is each of us would make an investment in a company based on our belief that that company has legs, that company has a path forward. We would bring the company in, they would present to us, and then we each make an individual decision. Do we want to invest our cash? It's about 20 of us in the room. So if we each invested $10,000, it'd be a couple $100,000 that we could then support that entrepreneur with. And that is very, very simply how it works. Now, it becomes a lot more detailed than that, but that's simply how it works. It's a group of folks like us. We have a common interest, and we listen to presentations. We then go through and do some background and some due diligence to make sure that it makes sense. But ultimately, we invest as a group. We'll create what you call a special purpose vehicle and invest through that special purpose vehicle. Usually it's an LLC, a limited liability company. Invest in that particular opportunity. So at this point, what I'd like to do, since this is our first meeting of Train, is share with you what some of the likely outcomes can be. And everyone's familiar with this first one, the Grand Slam home run. How do we define that Grand Slam? It's usually an opportunity where you're going to look at 10x returns. It's pretty significant. And you know, that kind of implies that, hey, you as an angel investor are greedy. But hold on. Let's look at some of the other possible outcomes that could occur. The second is the lucrative exit. Now, that's an exit where we exit the venture and we get our return plus maybe 100%. It could be up to 10x. Usually it's less. And as implied by the photo, the nest egg is there, but it takes a little effort to get to it. We've got to figure out and work for that particular nest egg. These are good exits as well. We're happy with these. The third is what we call the Harry Houdini. We escaped with a 1x return, no loss. We just basically got our money back. Okay? The fourth is we lost a little. We suffered a loss on the investment. Let's say we as a group invested $200,000, okay, in Opportunity X. And we got back $100,000. Well, we lost a little. We spent some time, spent some effort, lost a little bit of money. Disappointed that we did so, but remember, we've had a couple of the Grand Slams, so it all averages out. Not too concerned. Then, of course, there's the Grandchildren's Company. Now, the Grandchildren's Company is a company that's successful. It has legs. They have sales. They're producing revenue. They're producing cash flow, but not at a significant enough level to where there's an exit in sight. So I kind of hope that maybe my grandchildren, when they inherit this company, will see an exit at some point in time. Next, we see the zombie. Now, the zombie, as it says here, is the Walking Dead venture. It's kind of out there in Never Never Land. It won't be lucrative. It won't die. You can't declare a loss, so you can't take the loss on your taxes. It just kind of goes on and on and on. Then there's the deductible loss. Now, the deductible loss is one where you can actually take that tax loss. And the good news is, with tax rates going up, you get a bigger write-off. Then there's the opportunity to lose even more. Now, this is one of my favorites here. You lose your original investment, plus you've got to cover the cost of winding down the venture. Okay? You've got all these costs related to paying the lawyers to close it out, paying the accountants to close it out, You've got lease agreements that you have to end, relationships with people throughout the community, throughout the region. You may even have to pay the accountants to do the final books so that you can get that tax deduction we talked about on the last slide. Then you've got the one where the worst gets even worse. Now this one is just like the last one, with the exception that you have continuing and ongoing litigation, and you have no choice but to defend yourself through the company, regardless of the legal structure. Occasionally you see these happen. And then you have angel hell. In that particular case, you lose your investments. Seems to go on and on and on, but the big thing here is that you've got a tarnished reputation in the media. Your relationships with your co-investors are damaged, and every one of us are yelling and screaming at each other. Why did you encourage me to invest in that opportunity? How could you have been so stupid? And then, of course, there's the perfect loss. The perfect loss is I merely lost 100% of my investment and threw the dollars in the trash can. Now, why is all of this important? This is important because at the end of the day, an angel investment network like ours, we will, over the next year, look at approximately 30 companies a month. And out of that 30 companies a month, we're going to bring in about a dozen. And the process for bringing in that dozen to present to our network is that we're going to have to screen them based on our criteria. Then it goes to a screening team, and that screening team will further screen it to make sure that they feel comfortable that it's something that's presentable, it's an investable company that our group wants to invest in. Because you guys don't want to come to a meeting and waste your time. You want to have decent companies that meet our criteria. Okay? After we screen them, we whittle that 30 companies a month down to 1 or 2 a month. That gives us what? Between a dozen and a dozen and a half, maybe 2 dozen a year. And out of that, we're going to invest in 3 or 4 when we do our due diligence and we review the company. We go into the books, look at the details. Okay, so the reality is that there's a lot of work that goes into this. Now, out of that 3 or 4 companies a year, we are, over a 3 or 4 year period, going to put in place a dozen investments. But let's go back to the possible outcomes. What do the statistics say? There are statistics that have been derived over the past 20 years. Currently, there are 300 angel networks in the United States. And these statistics indicate that of every 10 investments that are made by angel investment networks and angel investment funds, that 1 will become a grand slam. Out of every 10, we'll have 2 or 3 that have a 1x to 10x return. We'll have 1 or 2 that you break even on. And the remainder you will lose money on. So what the angel investor is essentially doing is they are putting forth a portfolio of companies and they're making a bet. And the 10x, that never happens. It happens on the one individual case, but they have to invest in 10 or 12 companies to make that happen. On average, the angel investor is going to make 20% return on his money, on average. And he better be disciplined in the process in order to accomplish that objective. Because if he kind of takes it light and easy and he doesn't do his homework with the due diligence, he's probably going to get burned. Okay? So that kind of gives us a feel as to why it's important. So the next question becomes for us as an angel investment network, why should we invest? Why should our network invest in any particular opportunity? Well, here's some of the key reasons we would want to invest. It's scalable. That means it can grow with minimal resources into a very, very large opportunity. The most obvious example of that is any kind of software. Once you've written the code, once Bill Gates wrote the code for what was the initial operating system, the cost was simply making a new floppy disk at the time. If you remember the old floppies, the little, some of you were probably too young, but in my day, the computer started out, we had about an 8-inch floppy, or I think it was 8-inch, and it got reduced to 4, and then it got a little bit of a hard drive that was about 2.5 by 2.5. The only cost was that floppy. and rewriting it on that floppy and then distributing it to the end use customer. So it's very, very scalable, has a high growth potential. As you can imagine, if you value price it, you can price it well and make some pretty good returns on each unit, thereby enabling you to invest more money into R&D, further develop your software and establish a sustainable model. Our third item, that sustainable model. Without it being sustainable, if it's a one-time shot, we as an angel investment group aren't going to be interested because we want to create value that we can then utilize to invest in other opportunities. And it must provide an exceptional return on investment. So as an angel investor network, I will bring to you, to your screening team that you guys are going to be a part of, projects that I believe have the potential, pending our investigation, to provide exceptional returns. At the end of the day, every project that we look at, every project that we potentially invest in has to have the potential for this exceptional return, which essentially means it has to, in our minds, be a grand slam. Because if, at the end of the day, we begin accepting pretty good projects that, well, this one looks like it's a double, this one looks like it's a single. Well, if the best it's going to be is a double or a single, and it doesn't turn out quite like we're expecting, then we're dumbing down our potential investment opportunity. We're going to invest in projects that we believe have the potential to be a grand slam, and those projects are going to turn out based on that probability distribution I mentioned earlier. Only one of them will be a grand slam. That's just the reality. Now, does that mean that the guys in our community aren't sharp, that they're not smart? No. They could have a great idea. It could be fantastic. Everybody in the community is excited about it. The community is behind them. Locally, the product is being acquired. We're going regional. Everything looks great. And oh, by the way, there's a company out of Washington that just introduced something very, very similar, but it's at the next level. And sorry, but we just lost our momentum because they do it just a little bit better than we do it. But maybe that company doesn't exist. But what did happen was somebody just put their signature on a regulation in Nashville that precludes us from moving forward with this. There's some type of environmental impact here. Never was an issue before. Didn't know about it. But now the state feels that it's environmentally a disadvantage to us, and they close it down. We're out of business. Has nothing to do with the entrepreneurs we have here locally, being good people, being good managers, being smart people, doing a great job of executing. All kinds of things happen in this particular industry and put us in a position where we can have some issues. Now, what kind of projects from a criteria or fit standpoint, which ones are going to fit our network? Well, we've mentioned earlier, we're going to be an angel network. We're going to invest in that 150 to 500,000 range. So we're probably looking at late seed, early stage, probably not looking at expansion because at that level we need to be able to invest $1 million to $2 million. So we're kind of early on, but that also means the risk is higher. The location, we could stick with the Tri-Cities area, but the reality is that there's not enough deal flow in the Tri-Cities area. So we're probably going to expand it, and we'll look at companies from throughout the Southeast United States. Now, we'd like to be able to invest in that local company, so in order to create that sustainable model, we create alternative investment options from throughout the country, throughout the Southeast. The other thing we want to do is we want to find the best companies we can find to invest in. We don't want to have the tallest midget syndrome happen to us. You know, your son or daughter can play basketball, and they just clean the house with everybody here locally, and then they go to Knoxville. You know, it was a little tougher in Knoxville, but they made it through, and then they got to Nashville. Triple overtime, but they made it through. Okay, then they went to the regional. It was over in the first half. Okay, that's the tallest midget syndrome. And of course, what experience do we have here in this room? What are our members of Train involved in today? Are you into the medical side? If not, if we don't have a physician or someone in that industry, might not be too smart if we invest, because there's a lot that goes on there. Are we into the trucking industry, into the transportation industry? Heavy regulations in that industry. If you don't have someone with experience, you could potentially have problems. Finally, you've got closing the investment and the issues related to closing that investment. And here's where you really get to the meat of what we would call the due diligence. It's the management team. So what do we mean by a management team? We mean a diverse group at this stage of the company of 3 to 5 people who are going to manage that company and provide different skills to help bring it to the next level. The pre-money valuation. This is the entrepreneur's baby. He thinks it's worth a fortune, okay? He tells you his company is worth $3 million. What does he have? He has an idea. How many of you, let me see a show of hands, how many of you have had an idea in the past for a business? Okay, does anybody think that all of these ideas are unique? Okay, the idea itself is not worth $3 million. We as investors in Train want to see a management team, we want to see a strategic plan, we want to see that he or she, the entrepreneurs, have brought that product on a prototype basis to the market and validated that there's a need in the marketplace, okay? So we want to see that they have infrastructure in place. You know, if they're an organization that ultimately has this great idea and they've done a great job executing, but you go and you say, well, you know, you 3 are the primary shareholders, can you provide me with a copy of your cap table and your articles of incorporation with the state? And they can't do it. Well, that tells you they're not paying attention to some of the background details that they need to pay attention to. Okay? Now, that could mean they need coaching, or it could simply mean that they're not the right people. So what are some of the things that are common showstoppers? First off, as an investment network, each one of you are going to see a couple dozen projects a year. Your screening team is going to see somewhere in the range of 60 to 80 projects a year. And the key people who are bringing this all to you are going to see several hundred a year, okay? So if you run into an investor who wants you to provide security clearance, you know, you've got to get the NSA and the FBI to approve that you have the security, i.e., you got to sign a 10-page NDA. It's not going to happen. Number one, we just don't have the time. Number two, I'm not going to get each of you as investors in our group to sign that NDA. Number three, even if you do sign the NDA, I can't be responsible for enforcing it. It's not possible. Management wall is higher than the Great Wall. You know, essentially management really doesn't want to share. They say they will, but they don't want to share information about the company. You refuse our check. And I don't mean the check that we're issuing to support your company. I mean that background check that we asked you to do, you asked you to be willing to do when we went through the due diligence process. You've got a dirty balance sheet. Now, what does a dirty balance sheet mean? Well, you've got 129 investors. Each one have invested between $250 and $500. You've got a bunch of debt over here. You owe some vendors over here. There's all kinds of things going on your balance sheet, from loans to side loans, and a lot of it may not be documented. You must act now. How many of you guys have had the experience of going to the car dealership to buy a car? How many of you enjoy the experience when that car salesman is pushing you? Got to make a decision right this second. This deal's going to go away if you don't make a decision. Do you enjoy that experience? Is that fun? Well, as angel investors, we're disciplined with our money. Anytime that entrepreneur is telling me that we have to invest now, he just got crossed off the list. There is no now. If we don't do our homework, I can't represent you correctly and encourage the investment in this particular opportunity. And the executive team likes figures, 6 figures. Every one of them has a six-figure salary. Do we want to pay them? Are they really invested if we're paying them to develop the idea? Are they convinced the idea is a good idea? That really good company is that team that recognizes they have their idea, and part of it is they're putting their sweat and equity into the process to bring it to the next level. It's a family affair. Uncle Bob down at the corner station and Cousin Sue, they're all on the board of directors. They're throughout the management team. You know, families have their place, but not in a scalable business that you're going to try to bring to investors to sell. So you want to be the CEO. Sometimes we'll encounter entrepreneurs whose dream it is to be the CEO. Who knows why we don't want to invest in a company like that? Anybody have any speculation? What is our goal as angel investors? Our goal is that termination event, right? If this guy wants to be the CEO and build this company and be CEO for the next 30 years, there is no termination event. Okay, there's no chance for us to get our money out. Now, you guys are going to be happy with me if it's a successful company, but he won't sell it? They set a messy cap table. I'll leave that one there. We get to invest in how many companies? I've had entrepreneurs bring the Angel Roundtable opportunities where they carve out specific assets, and there's 2 or 3 companies we have to invest in the one and get the whole deal. But what they're really looking for is for us to invest in the operating company. So they want us to invest in the operating company, which is going to develop the software, which becomes the property of a technology company, which we don't have any rights to. Does this make sense? Where's the paper? Again, you have shareholders. Have you papered? Have you issued stock certificates? Do they have evidence that there is actually a relationship with the company and supporting their investment in that company? This is one of my favorites, the all-in-one company. It's a company that is just packed. If we do this and this and this, each of these markets are great opportunities for us, but they're all real small. And in order to make it work, we got to make all 4 of them work. If we don't make all 4 of them work, suddenly it's not a good idea anymore. But there's so much opportunity. Look at the 4. All 4 of them have potential. Let's prove one. If one of them has legs and we can really grow it, then it really becomes compelling. But if I've got to do all 4 to make it work, the risk really goes up for my angel investment group. I'm smart, I can do that myself. A number of the investors that we encounter, they find themselves in a position where they are extremely smart people. They've developed ideas. They've patented their ideas, okay? So they decide they don't want to share. They don't understand the concept of the bigger the pie, the more there is to share. And so they decide to do it themselves. So they're going to be the CFO, and they're going to be the vice president of marketing, and they're going to be the CEO. And oh, by the way, somehow I guess they've figured out that they have more than 24 hours in the days that you and I have. Not sure how that gets there, but don't look over my shoulder. You know, as investors, do you expect to have an opportunity to see how the company's doing? To know, is the money that you've employed in this company actually creating value and gaining the traction that you expected it to gain? If that CEO and that executive team are reticent to allow you to have that opportunity, then we need to look again. They are from the government and they're here to help you. Okay? The government regulators are trying to support the company as they evolve their model. And you learn that either the local, the state, or the federal government is involved. Okay? First off, let's say the intentions are good. Whenever that happens, it takes more time. And time to us, as members of Train, is money. So you have 2 startups that you're CEO of. Okay, so are you not confident in this one? Oh yeah, I'm confident, but this one's a good idea. Well, which one are you going to focus on? You know, I want to invest our funds in someone and in something that is focused, in someone or something that is executable. Okay, I don't want to invest our funds and not know, well, is it going to get, are those funds and those efforts going to get expended here, or really are they going to get expended over here? So these are examples of some of the common showstoppers that might result and prevent us from investing. What I've tried to share with you today is the life of the angel investor. Tried to put you in that seat to give you a feel for what are the things that angel investor has to consider as he makes an investment. And as you can see, while it's a lot of fun, I'll share with you, you can probably tell from my demeanor, I'm very enthusiastic and I love what I do. I've been doing it for a number of years. It's a lot of fun to take a company and grow it, but there's a lot of background work, a lot of detail, and a lot of risk that goes into it. Kurt, do we have time for just a couple of questions?
How about lunch?
Okay, you do it at lunch?
Yeah,
Okay, thanks. I'll leave that with you then.